Podcast Simple Mindspace. Welcome to Simple Mindspace, the podcast that helps you master your money and your mind. I'm your host, and today we have an important topic to discuss. But before we dive into that, I want to remind you to like, share, and subscribe to our podcast if you find the content valuable. Now let's get started. Main topic: the global stock market collapse. Today, we are going to talk about the recent collapse in the global stock market. Stock markets all around the world took a tumble, with almost every big stock experiencing a significant dip. However, amidst all the chaos, there was one company that stood out. We will get to that later, but let's begin by exploring where this stock market collapse originated. The Japanese stock market crash. The Japanese stock market had its worst day in almost 40 years. In fact, it crashed worse today than at any time during the pandemic. The last time it experienced such a downfall was on Black Monday in 1987, an infamous day when the world lost trillions of dollars in the stock market in just a few hours. But why did this happen? One hypothesis is something called a carry trade. Over the past few years, Japan has kept its interest rates low and experienced minimal inflation. As a result, many large corporations and Wall Street firms have been borrowing money in Japanese yen with low interest rates and investing it in other currencies and stocks of countries like Australia and the US, which offer higher interest rates. It is estimated that between 5 and 10% of the entire American stock market is on this kind of carry trade. However, with Japan raising its interest rates for the first time in March, and again just 5 days ago, the Wall Street firms and financial institutions that relied on Japan's cheap borrowing costs are now worried. They fear that their debt payments will increase or that they will no longer have access to cheap money for future investments in the stock market. Renowned investor Warren Buffett, who has been known for outperforming the stock market for about 70 years, cashed out almost immediately after hearing this news. This move may indicate his anticipation of a market correction or collapse in the near future. Fears of a real recession. Apart from the specific reasons for the Japanese stock market crash, there are broader concerns about a real recession. History shows us that after World War I, the world expected to experience something similar to the Great Depression. However, the immediate aftermath of the war saw a brief recession followed by the Roaring Twenties, a time of economic growth and wealth accumulation for the wealthy elite. Today, some investors fear that we might be following a similar pattern. Several countries, including Canada and Germany, have been in a GDP per capita recession for a few years now. However, high immigration numbers artificially inflate the total GDP, allowing governments and Wall Street to claim that the economy is growing. But beneath the surface, signs of a looming recession are evident. Unemployment in the USA keeps rising, and job creation keeps falling. The unemployment rate is currently the highest it has been since the pandemic started. The sum rule, a reliable recession indicator, suggests that if the 3-month moving average of the unemployment rate rises by 0.5 percentage point from its low in the previous year, a downturn is likely to follow. This is what appears to be happening in the United States right now. Another recession indicator is the inversion yield curve in government bonds. During periods of economic uncertainty, investors prefer the safety of long-term bonds, leading to higher demand and lower yields on these bonds compared to shorter-term ones. This phenomenon suggests that investors view short-term bonds as riskier investments due to the perceived economic uncertainty. Consumer spending is another crucial factor to consider when discussing a recession. In the USA, approximately 70% of the entire American economy depends on consumer spending. If people spend less money, a recession becomes more likely. While consumer spending has been steadily increasing recently, it is important to note that it is accompanied by skyrocketing debts and bankruptcies. This means that consumers are spending more, but a significant portion of that spending is financed through debt. If economic conditions worsen to the point where the average American can no longer afford to repay their debts, a crisis similar to the 2008 financial crisis may occur. Strange events and concerns. In addition to the recession fears, several other strange events are occurring in the financial markets. One notable occurrence is the spike in the VIX, a volatility indicator in the stock market. The VIX has reached levels higher than those seen at the start of the pandemic, when the global economy virtually shut down. This high volatility indicates that investors are extremely uncertain about the stock market's future in the near term. Furthermore, amidst the global market meltdown, one company's stock price skyrocketed. That company was Lockheed Martin, the largest military company in the world. Initially, Lockheed Martin's stock rose by over 20%, signaling that some investors saw value in investing in the American military. Although the stock eventually fell back to normal levels, this incident raises concerns about the possibility of a war. The war in the Middle East. The war in the Middle East is showing some worrying signs. Turkey's President Erdogan recently stated that he could send troops to help in Palestine. If Turkey were to deploy troops on the ground, it would escalate the war and potentially trigger a response from Israel's allies, including the United States. Moreover, Turkey recently blocked social media apps like Instagram, indicating a pre-war sign as they seek to control online information. News reports have also suggested that an Iranian attack on Israel is likely, following Israel's assassination of a Hamas leader. If the Iranian attack occurs, the U.S. and Western powers may become further involved in the Middle East conflict. U.S. government spending and debt. A ticking time bomb that has been gaining more attention is the U.S. government's spending and debt. Currently, around 30% of the federal budget is being financed through debt. Furthermore, a significant portion of the debt is created to pay off previous debts, creating a vicious cycle. The U.S. government is on track to run out of money soon, adding approximately $1 trillion to the debt every 100 days. Programs like Social Security, which were initially designed for a population with a lower life expectancy, face challenges as people live longer. Social Security is currently the largest expense of the U.S. government, accounting for 22% of the budget. Changes to this program or its potential shutdown within the next decade are inevitable. Many countries, including the U.S., are adopting a concept called modern monetary theory or money printing. This theory suggests that debts no longer matter as long as the money supply keeps increasing. However, history has shown that ignoring debts and increasing the money supply is often a sign of a dying empire. Rome, for example, attempted a similar approach near the end of its empire while accumulating vast amounts of debt. Although modern economists argue that this time is different, historical patterns suggest that debts will eventually come due, leading to a potential collapse of the entire system. Conclusion. In conclusion, the recent collapse in the global stock market has raised concerns about a looming recession and other troubling events. From the Japanese stock market crash to fears of a real recession, the signs are pointing towards an uncertain future. Volatility indicators, strange market movements, and the possibility of war in the Middle East are further adding to the anxiety. The U.S. government's spending and debt, along with the adoption of modern monetary theory, also raise questions about the sustainability of the current economic system. As investors, it is essential to be cautious and make smart decisions during times of volatility. While there have been multiple downturns in the market over the past few years, each followed by a rebound, the current situation presents unique challenges. Whether this is the bottom of the market or a time to buy or sell remains uncertain. Only time will tell. In the meantime, stay informed and be safe with your money. Outro. Thank you for joining us today on Simple Mind Space. If you found this episode valuable, don't forget to like, share, and subscribe to our podcast. We appreciate your support. Until next time, take care and remember to master your money and your mind.